Good afternoon, everyone. Welcome. I'm Larry Guthrie, Director of Communications with CCIM Institute. Welcome to today's webinar. It's Insights, Trends, and Outlook of a Shifting CRE Market. In today's webinar, the panel of esteemed speakers from CoStar Group will focus on recent points of interest in the macroeconomy and its outlook, as well as a high-level overview of the themes impacting the CRE market and a review of recent trends within each sector. Today's webinar is sponsored by our president sponsor, CoStar Group. And CoStar Group is a leading global provider of online real estate marketplaces, information, and analytics in the commercial and residential property markets. The company is digitizing the world's real estate, empowering all people to discover properties, insights, and connections that improve their businesses and lives. With over 25 industry-leading brands, CoStar Group has 80 offices in 14 countries. CoStar Group is based in Washington, D.C. and has over 5,400 employees. Now, during the presentation, please feel free to ask questions throughout using the Q&A tab. We'll be answering as many as we can. And if you're experiencing any technical difficulties, please use the chat feature to help ask for help with that. The recording and the accompanying presentation will be emailed to all registered attendees. I'm excited to introduce our first panelist, Dr. Christine Cooper, CoStar Group's Chief U.S. Economist and Managing Director. In her role, Christine leads a team that provides insights and analysis of national and regional macroeconomic conditions and leading market analytics for the Western and Southwestern United States, with commercial real estate market analysis covering metros in 19 states. Prior to CoStar Group, she led the Institute for Applied Economics at the Los Angeles County Economic Development Corporation, producing numerous studies and presentations for government agencies, industry leaders, and legislative bodies. Dr. Cooper holds a PhD in development and institutional economics. Christine, we are so excited to hear from you, and I will turn the floor over to you.
Well, thanks so much. Such a pleasure to be here. And good afternoon. Looking forward to showing this presentation we have to share. I'm going to start with, is this okay? We're all seeing this okay? Okay. I'm going to start with a little outlook on the economic environment, and it's really impacting our property sector. So I want to discuss just a little bit about what we see going on in the economy. And then I'm going to turn to what CoStar data is showing us. We have a massive amount of data, and we want to see how the property markets are faring. So a lot of what we see going through the economy right now is really the result of the pandemic. It started 2.5 years ago. We're still feeling a lot of the after effects of that. And the number one thing that we're seeing right now, of course, is inflation, right? Inflation is still running really hot, more than a 40-year high. This is the consumer price index. It's eased off a little bit. You can see that blue line. It's eased off a bit since reaching a peak in June at 9.1%. That's mostly because gasoline prices have fallen, but it's still really high, right? And the core consumer price index, which doesn't account for food and energy, which are really volatile, this has been accelerating since August, after we thought it had already peaked, but now you can see that red line is actually on the way up again. This suggests that inflation is really becoming more broad-based, spreading across other categories, not just food and energy, which had been disrupted by the war in Europe, but also furniture and services and that kind of thing. In general, this high inflation has been mostly driven by physical goods that we bought during the pandemic. As we were sitting at home, we needed furniture, we needed exercise equipment, we bought a computer, so our companies bought computers for us to work from home. And that was all facilitated by trillions of dollars of fiscal stimulus, right, that was sent to households and to businesses to keep the economy afloat while we were all shut down. So that really drove prices higher. But what we see now is goods inflation coming down, and now services are rising. So that would be transportation, like air travel, or going out for meals, or medical care. That price has been rising, and housing. We see housing prices also going up quite quickly. Well, in response to rampant inflation, the Federal Reserve has stepped in and is tightening monetary policy. It's raising its overnight lending rate and reducing its asset holdings, trying to reduce liquidity in the market so there's not so much to spend and push prices higher. This is the most aggressive tightening cycle we've seen since the 1980s, adding about 300 basis points since March of this year. And we're expecting another 125 basis points by the end of the year. So bringing the policy rate from near 25 basis points to 4.5% by the end of December. And maybe even more early next year, another 50 basis points. And that's going to bring us back to rates that we saw before the great financial crisis. Well, the purpose of this is really to slow the economy down and to pull back on demand to bring prices back down. And that's really what we see happening. This is showing both factory activity and services activity have slowed from a year ago. And the manufacturing activity is really about to contract. If that blue line falls below the dashed line, manufacturing is actually in contraction. And this isn't just in the US. There has been a sharp global downturn as well, including in Europe, in Canada, and the UK, and Asia, as a result of higher prices and monetary policy responding. Currently, we have about 80, 90 central banks across the globe actually tightening policy. So this is a global-wide phenomenon that we're living through. As activity slows, businesses are going to pull back on investment and on hiring. So the labor market is going to slow down as well, and we're probably going to see some job losses coming next year as employers cut staff. Well, that just means that we're going to see the economy fall into recession early next year. Many Wall Street estimates are for 2020 to see GDP growth around 1.5%, and slowing to maybe 0 or even being slightly negative in 2023. After recovery, then we'll recover in 2024. But we expect the recession to be pretty mild. Why would we think that? Because there isn't a credit crisis like we had in the great financial crisis. Household and business balance sheets are really solid. So they could probably withstand some small short downturn, right? And also the labor market still is really tight. We have still adding hundreds of thousands of jobs and not seeing a whole lot in the layoffs and firing. So this recession is going to be more like the short 1990 recession. It's not going to be like the great financial crisis. Eventually, with a recession and activity slowing, we're going to see inflation ease just because of that. It's probably going to get down to 3.5% by the end of next year. It's going to be a little slow, so it'll be over 6% by the end of this year, but it'll come down. And that's pretty much what we see in the economy overall right now. Of course, the pandemic has impacted property markets as well. And we're still feeling all those effects. So I'm going to have a quick look at some of the impacts in different property sectors. I'll show you 4 slides. I'll show you absorption, deliveries, vacancy, and rent growth for a couple different property sectors. And we can start with the office. We know the office sector has been very critically impacted. Hybrid work really is weakening demand. Everybody is working from home still. Quite a few people are working from home. And so many employees, occupiers, because they're working at home, occupiers are shedding space. You can see that net absorption here was negative for 7 out of the last 10 quarters, bringing cumulative absorption to, since the start of the pandemic, to about 120 million square feet, which is really unusual. Think of this, during that same time period, we added about 1 million employees in office using employment. And 1 million, if you think about 150 square feet per employee or 200, we would expect to have seen net absorption rise by 200 million. And instead, it fell over that time period by 120. So you can see the difference in occupied space because of the work from home. At the same time, there was a lot of projects that were initiated before the pandemic, and they are coming into completion shortly. So we are still delivering office property, but that's outpacing demand. And when we put when we put absorption with deliveries, we're going to see the vacancy rate. And you can see vacancy has been rising with those deliveries and the negative net absorption, and is now 12.5%. We do see that rising still as these deliveries come into market, and office vacancy is going to be quite elevated throughout there. This is a historically high, seen higher than what was seen in the great financial crisis that you can see there earlier, and it's going to remain elevated until we come to some resolution in occupancy, in hybrid work, and in deliveries. Well, that's going to affect the rental market, the rental of the office property as well. You can see the bars are rent growth, and they fell negative in COVID years. They're coming back a little bit, but we still see we're very slow rental growth. And of course, we do know that there's a lot of concessions or TIs being added into any lease agreements now. And so that we may not be capturing that fully. And so rent growth might be even slower than what we're looking at. If we inflation adjust those rents, those are really negative at the moment, right? Because we still have the 8% inflation. In the industrial market, the pandemic really supercharged what was actually happening. We were moving into e-commerce already, but everybody's now hunkered at home, couldn't go to stores, you're buying everything online, and that really needed to come in through ports and warehouses before it was delivered to our homes. Delivering all this stuff to our homes rather than to retail stores really required a lot more space. So this has really supercharged this property sector. And you can see that here. This is an amazing picture. Absorption since the onset of the pandemic totaled almost 1 billion square feet, with about 100 million square feet absorbed in the third quarter alone. You can see that huge spike in 2021. Amazing. And of course, in the face of this demand, it's not stopping either. You can see our forecast for what we expect the industrial sector to continue absorption quite high levels. Deliveries came online trying to meet this demand, and there's a lot more in the pipeline that's coming through. But those deliveries were certainly not enough yet to meet that absorption. And so industrial vacancy, we can put deliveries and absorption together. We can see the vacancy rate is still falling at 3.9%, a record low, historic low in the second quarter, and is only going to rise just gently over the forecast period as deliveries do come online. Well, the opposite of industrial, of course, is, industrial rents responded quite strongly to this amazing amount of absorption and not enough deliveries. You can see even more recently now, we're seeing 12% rent growth in industrial property right now. It's expected to fall down slightly over the time as vacancy rises again and deliveries are matching absorption. So this has just been an amazing run for industrial rents. And the last property type I'll talk about is retail. And of course, this is a sector that did not benefit from the pandemic and is not still back to where it should be. We're all trying to avoid malls and being in contact and in person while we were buying everything online. And also with remote work in office space and downtown centers, urban retail just basically disappeared. Really, this is an extension of a trend that was already largely started before the pandemic as we were moving to e-commerce, but this pretty much put the nail in the coffin of retail for quite some time. And we can see that here in absorption for retail. It is recovering now from the pandemic lows. You can see early on in the pandemic in 2020, it really went negative right away when the pandemic hit. It did recover a little bit during 2021 as vaccines were available and people started being more comfortable going out into retail, but it has been slowing down a little bit since that time period. At the same time, though, retail deliveries have been at all-time lows. Nobody is bringing new retail, very few are bringing new retail product into the market. And this is just not even meeting the very limited absorption that we are now seeing for the past year and a half. So when we put absorption with deliveries, we can see that retail vacancy has really fallen and will continue to slide lower, just over 4% in coming years. So that is really, and again, it is a sector that is going to continue to have a little bit of struggles, depending on the type of property. For example, malls, the vacancy rate of malls is much higher, whereas neighborhood centers and general retail is going to be much lower. And given that picture, we see a pretty good rent growth in retail rents, comparatively speaking to earlier. We have rent growth over 4% right now in the retail sector. Again, in inflation adjusted terms, this is all negative. Rent growth is negative because we do have a high inflation. Just a few words on capital markets. We would think with interest rates rising, this is going to affect capital market activity. It has been doing so on sales activity. This is our picture of transaction activity annual as money is becoming more expensive. We're looking at a time period where we're pretty much done with free money. You're seeing quarterly transaction volumes here. We have just recorded the third quarter transaction volume that will increase as we get more information, but it is outpacing 2021. So it could be that we're going to see a fourth quarter that would the overall 2022 would exceed 2021. 2021 Q4 was a historic amount of transaction activity. So I'm not going to place my bets on that. We'll have the same amount of transaction activity in Q4 this year. The slowdown is started in the third quarter, and you can see that is smaller than the third quarter of 2021. So sales activity has been trailing downward. And that has been across all property types and all geographies, and it really is a factor due to the increased debt costs. Let's have a look here. Price appreciation is still continuing across most property types. I've added hotel and multifamily here as well. Multifamily is in green. It did see a little hiccup this year where demand is slowing, so price appreciation kind of stabilized. But the yellow line is showing industrial. That price appreciation has been really strong over this time period. The aqua green color is hotel, which did struggle during the pandemic as travel came to an abrupt halt, but now it's starting to see price appreciation as well. Whereas the other two sectors, office and retail, have seen very slow price appreciation. One other thing I'd like to say, we are expecting to see some distressed sales come online, but we don't see it yet in CoStar data or in the CMBS data market, but they usually lag economic activity quite a bit. So we might see them tick higher in coming quarters, especially because we've seen CMBS originations fall significantly. So that is an area that you might keep in mind. With that, that's what we see in our CoStar data, is the property market and the outlook. If you have any other questions, we'll take them at the end. It's my pleasure now to turn it over to my colleague, Ian Gruz, to continue our conversation and to share some insights into what 10X's experience with their online live bid platform.
Thanks, Christine. Good afternoon. I've been a CCIM for more than 20 years and was the Institute's past National Chair of Marketing and President of CCIM New York City. I'm also pleased to share that in addition to CoStar and LoopNet, 10X has been a CCIM sponsor for the past 7 years, and all of our new hires take the Ward Center class, Foundations for Success in Commercial Real Estate. CCIMs have sold more than 150 properties on 10X, totaling in excess of $250 million. So thank you. It's my pleasure to introduce my colleague, Brandon Liu, Head of Sales, to share insights on the market trends we are experiencing. Thanks.
Thank you, Ian and Christine. I appreciate it. And good afternoon, everyone. So as Ian mentioned, I'm here to talk a little bit about what we're seeing on 10X, give you some insight into the shifting transaction marketplace. So first of all, just to give a quick intro, who and what is 10X. So we are the largest digital commercial real estate auction platform for brokers, sellers, and buyers to transact with greater speed and certainty. And Ian mentioned, we've had really this platform is really designed for brokers and owners to be able to transact real estate. And over since 10X's existence, there's been over $30 billion of sales transactions on the platform. Over 10,000 properties have been traded and closed. And the average list to close is 90 days. And those deals that do trade on the platform have a 95% close rate. And a lot of that has to do with how the process is designed. With the auction process, where that due diligence is upfront and that bidder qualification is done. So it eliminates the retrades that happen typically in the traditional process. So what is unique about 10X is the fact that it is an auction platform, and we are seeing the market live happen as it happens. So as an example, we have auctions every other week. So as an example, we have an auction coming up next week where we have over 100 assets that brokers and sellers are bringing to the platform, potentially sell. And what we will see next week is the marketplace live and happening. So buyers will give us direct feedback as to what they're seeing and what they feel the value of real estate is. So what we're seeing, first of all, just to give you some perspective, what you're looking at here on the screen is that purple line is the trade rate on 10X, and the blue line is the overall marketplace. And what we're seeing on assets that are trading, the percentage of listings that are being brought to the platform or to the marketplace overall, and what the percentage of those assets that are trading. So you can see really what Christine was talking about is the increase in the interest rate has really had a significant impact on the trade rate for both 10X and for the offline market. You can see how we work really well in concert with each other, and seeing that, ultimately 10X is a marketplace just done online versus the traditional process offline. So you can see, like that dotted line represents really when we started to see the interest rates increase and the resulting impact of those increases in the marketplace. And so the question is, like, why is it happening, right? So, one of the questions we get a lot, and talking to a lot of our clients and brokers and ownerships clients, is the fact that, okay, like what, how much has the buyer pool shrunk? And what's really unique again on 10X is we could see when they actually quantify, what that is. So we, are able to track what the average unique bidders per asset is on our platform. So again, that dotted line is where we were at a year ago, and you can see what the average unique bidder was per asset a year ago, which is 3.6. And we can see now, heading into Q4, that the average unique bidder per asset is down to 2.7. So we have seen, like roughly we can definitively say, at least on the 10X platform, and as you saw in the previous slide, how again we are the 10X marketplace and the offline marketplace, is the fact that you can see that they're aligned, that the buyer pool has shrunk roughly about 25%. You can even see, like, go back a little bit further to the peak of the market back in earlier of 21, that it shrunk 40% roughly from where it was at in that peak. But so far this year, we've seen the buyer pool has shrunk about 25% because of the interest rate increases in the marketplace. Okay. Now, what's also interesting is what we're able to track is to see, like, the behaviors from buyers and both sellers. So one of the things we track is the high bid to reserve, but also, like, think about in the stock market as an example, which is the bid ask spread. So what does that spread really look like of what the reserve is and what the high bid that buyers are bidding to? And again, that gives you perspective into what their perceived value of those assets are. So what we're seeing is, like, right, you can see that dotted line again when the interest rates were starting to jump up earlier this year, is that buyers were really quick to react to the interest rate increases in how they were bidding or evaluating and valuating the assets that are being brought in the marketplace. And you can see that, heading into Q4, they were down to 65%. So that bid ask spread, or that high bid to reserve, has really been spreading as buyers are looking for the bottom in the market and evaluating what they're valuing real estate deals at. All right. And again, it's been about a 27% drop so far this year. Now, what we're seeing here on the flip side is in the seller behavior. So the buyers are reacting relatively quick, but you see on the seller behavior side, what you're seeing here on these charts is the blue lines represents the what we call the average reserve reduction. So you have your the reserve that is set. It's an undisclosed reserve amount. Buyers don't know what that reserve amount is, and they're searching for that reserve amount during auction day. So they're bidding up to try to search for what that reserve price is. And typically what happens once you get relatively close to that reserve and you got a number of bidders that are engaged in the asset, typically what owners and sellers would do is they'll actually lower the reserve to meet that market to encourage a bidding war, right? To try to drive up the price as much as possible. And so what you're seeing is the blue bars are that reserve reduction for assets that don't sell, and the purple bar are for the assets that do sell. And you can see is that, you know, like earlier in the year, we saw that buyer behavior really shift and change, and they were really dropping relatively quick in their evaluations for real estate. And then the sellers really didn't adapt too much. You know, they weren't adapting quite quickly. But what you could see in the trend that we're seeing here in October is that we saw the most amount of reserve reduction happen this past October in comparison to where we were at any point in this year. And again, so like that's starting to see that sellers are starting to adapt and have proper expectations of where pricing is currently at, and then where it's heading. And you know, and what we're going to see over the next coming quarters is that we'll have more alignment with buyer and seller expectations on pricing. And we'll start to see transactional volume most likely start to pick up from there. You start to see trade rates, you know, move up. But again, what we're seeing is that dislocation in a shifting market right now, and how we're able to look at that. Okay, so here are a few key takeaways. One is obviously the increase in the federal funds effective rate has had a significant impact in the commercial real estate, and it will continue, as Christine talked about, with the rates continue to move up. The trade rate is down this year in comparison to where it was last year, so it will continue most likely to go down with the rates going up until that the buyers and sellers are more aligned. The buyer pool has shrunk roughly about 25%. And they have been quicker to react to the shift in the market, which we typically do see in market cycles. And then the sellers have been a little bit slower to react, but we're starting to see the sellers are starting to really have the proper pricing expectations going forward. But again, you know, still have some time for that alignment to come forth and really start to see the markets more aligned as we go forward. So with that, I'm going to hand it over to Martin, talk to you over about LoopNet and some of the trends that we're seeing in online commercial real estate advertising. So thank you.
Hopefully everybody can see that all right and hear me fine. Brandon, thank you. That was great. So now Christine's helped us with where the economy's going, and she's kind of looked into her crystal ball, and she's told us what to kind of expect over the next couple of years. Looks like we're going to dip into a little bit of recession. Hopefully it's going to pass quickly and not be like the other ones we've been through in the past 20 years or so. And Brandon talked about the capital markets and starting to see that the buyer pool is shrinking a little bit, and overall slowing in trade rates. So it makes it even more important now as the economy slows to talk about marketing our properties. So my name is Martin Bloom. I've been a CCIM for almost 20 years, not quite as long as Ian, but hopefully I'll be catching up with him soon. I'm excited to be able to share this information with my fellow CCIMs. I'm a former retail and cap markets broker. I was with CBRE and Colliers for about 15 years, but now my specialty is helping brokers and owners advertise their properties using the CoStar digital marketing platform on our 4 websites, which are CoStar, LoopNet, CityFeet, and Showcase. So let's take you through a scenario. So you just got this new listing. You're excited, right? I mean, got this new listing, need to figure out what to do with it. So traditionally, how would you market it? Right, a number of different ways. Well, you know, first we take some snappy iPhone pictures and send over some bullet points to our marketing person, and they put together a flyer, which we then kind of blast out to the brokerage community, and we'd put up a sign on the property. Always a cost associated with that, and it just matters for the people that drive by it. Next, we might throw a broker open house. We give away some, you know, we'd have lunch catered in, and we'd give away some gift cards, maybe have a raffle for a kayak or a trip or something like that. Usually those happen, and then there's another one next week, so hopefully our property didn't get forgotten. We'd probably cold or warm call some prospects that might be a good fit for the property, and we'd reach out to our broker colleagues. see who they're running around town with. It might be a good fit. I remember back when I first started, I would go to the older, kind of more, I say older, the more experienced brokers and ask them who to call that might be right for the listing. And they would, go through their Rolodex and their BlackBerry contacts, and they'd say, here, call this guy or call this lady. He or she buys properties like that. But then all of a sudden, that broker might now be in my deal for just sharing that contact with me. Well, all of these traditional methods are great and we need to keep doing them. But that being said, we also know that finding the right tenant or buyer is a numbers game. So we need to ask ourselves, am I casting the biggest net that I can? The trend in advertising commercial real estate now is switching. It's starting to lean into an internet or digital marketing trend. And why? It's just simple. It casts a much bigger net than we can do through traditional methods. So let's ask ourselves a few questions like, is the way I'm currently marketing my properties working? Am I getting the highest visibility I can for my listings? Who's my audience? Am I getting in front of the right people to buy or lease the listing? And finally, do I have a marketing budget, and what is it? So if you don't remember anything else that I say today, remember this statistic. 88% of tenants and investors start their search for properties to buy or lease on the internet. It's not in person. They're doing virtual tours. And it typically starts with just a simple Google search, like somebody will be sitting in their office and needs space to lease, office space to lease in Dallas. So they type into a Google search, office space for lease in Dallas. Or I'm driving around in my car around the Chicago market and I need to find land to build a building on. So I'll search for land for sale in Chicago, or big box retail in Boston. Then what happens is Google populates the search results with websites where they can go and find properties that fit the criteria that they're looking for. Works the same for tenant rep brokers that might be in Seattle that have an office requirement to fill in Austin. They're doing a Google search. Their tenant is doing a Google search to do their own due diligence, and they're either doing it that way or they're going to CoStar and they're pulling it up on a list. Additionally, online marketing services now have the capability to target and retarget prospects once they've shown interest in a property. So once a prospect has engaged in the property advertising, we politely follow them around the internet to the other websites that they visit and present your property to them over and over and over using a combination of banner and display advertising and social media. The whole purpose is to redirect them back to the property. So I know what you're thinking. It sounds a little bit kind of like what Amazon does once you've left their website. So it's Saturday afternoon, you're looking for some patio furniture because it's a nice day and you're like, I need to replace my patio furniture. So you do a search on Amazon, you see some sets that you like, then you go leave the site, you go do other things around the house, and you come back later on in the day, you might check ESPN to see what the scores were, or check the news on CNN's website or on the Wall Street Journal. And what do you see off to the right or the top of the page? That's right. You see an Amazon ad for patio furniture that you were looking at earlier. And why do they do that? Well, they do it because it works. So what does this digital advertising look like? Digital advertising has become eye-catching and interactive. Marketing campaigns are now using high definition photography and video that's shot by professional architectural photographers. They're adding Matterport tours and 3D tours. They're doing drone photography and video. And now they've hired a whole group of commercial real estate copywriters that write far better than I do, that write custom content to tell your property's story. I promise you it's way better than me sending bullet points like signalized intersection to my marketing assistant and throwing some iPhone pics to her that she needs to color correct and so that she can put them on my flyer. Tenant and buyer search activity is at an all-time high for digital advertising of commercial real estate. It's very busy right now with active searchers across all asset types. Just in an average month, we see about 12 million unique visitors a month. In the last month, we hit our highest numbers, which was in excess of 13 million, all searching for real estate to lease or buy. This is just an example of what a digital advertising ad might look like through a digital advertising website. You'll notice this is large, it's eye-catching photography, big pictures and I apologize, I wish this was a little bit bigger and it had some animation to it so that you could see what typically happens is a prospect will pan across the pictures, looking at, they might do the 3D Matterport tours, they'll have automated drone and video that might kick off. Then you'll notice some curated highlights about the area and the property so that they can start thinking about what's going to work for their employee base, which is very important now. It's like, where are they going to be able to go to lunch? Is there a gym in the building? What is the layout of the office space? You can virtually tour it, so they might even be able to start placing people in specific places in the office so they can kind of pre-qualify themselves and also virtually tour the space. At the bottom, you might typically see the available spaces, and with a pull-down menu where it'll have a floor plan so that they can actually start looking at a floor plan or the tenant improvements that are already in the space. Over to the right, and this was always important to me as a broker, is that you can brand yourself. There's branding over there for you and your company, whether it's the owner or whether it's the broker. And additionally, there's contact information there with a direct click through to email, so prospects can email you questions and set up tours directly through the website. So finally, I thought it might be helpful to look at to see who's actually looking and what the traffic looks like. So on this next slide, this chart is just showing the year-over-year traffic. And I apologize, I don't use as many charts and graphs as my predecessors. I'm not that good at that. This chart just shows year-over-year traffic and how many total searchers are doing online searches and what they're looking for. So this is September. This is the month of September 2021 versus the month of September 22. And the positive news is that activity is still really strong and hasn't dropped off that much as far as online activity searching for real estate. Usual suspects are what you would think. Office and retail, flex hospitality and specialty are starting to decrease. I don't know what's going on with sports and entertainment. Huge drop off there, probably because people weren't getting out for the pandemic. And then the darlings currently, industrial and multifamily and healthcare, are getting more and more views online and more traffic. So the most common question that I get asked is, okay, well, I see all this traffic, but who's actually looking? So I thought we could take a look at that. So these are on this next slide are the most active lease prospects. And this is these are national searchers. So this information is may or may not be what makes sense in your geography or your market. I'm happy to, if you want to reach out to me, I'm happy to, deep dive into what's going on specifically in your market, who's looking as far as searchers looking for lease and to buy. But this is this just shows who's out there doing the most searches right now. For instance, if I have office space for lease, I'm probably going to one of the insurance agencies. It seems like they're still leasing a lot of space. And in retail, maybe the telecoms. I don't know what Crocs is doing, but Crocs is all over the place right now, doing a bunch of searches. And then medical, most of the hospital groups are leasing and buying the space. For sale, same scenario. Who's buying office right now? Cisco's out there, IBM's out there. As far as retail goes, Matthews Tire and Auto Service Centers are buying properties, or at least searching to buy properties. As far as industrial and flex, Cisco and FedEx. And then the hospital systems are out there buying real estate. I think that pretty much sums it up for me. I want to thank you all for providing us this forum and allowing us to speak on the webinar. It's always great to talk to our colleagues. And I think that we have time for some questions.
Yeah, we've got, this is Matt Bloker from CoStar Group. We've got a couple questions that have come in, so thank you for those that have submitted, and there's still time to submit questions. Christine, we have one for you. Today's GDP report came out pretty strong. Does that change anything in your outlook for a recession or for Fed policy?
Yeah, it did come in a little strong, right? It was like a 2.6 or something. But I mean, expectations were for 2.3. We had pretty good momentum coming into the third quarter, so we weren't expecting it to be dropping. But just so you know, a large portion of that was really due to trade, net trade. We had a lot of exports and not many imports. And that is a very volatile component of GDP. And you remember the first 2 quarters actually were negative, and also because of trade. So in addition to inventories, of course, but you know, so it swaps between quarter to quarter. So we can't really depend on that. The increase in trade was accounted for more than that increase in GDP in the third quarter. So we're still slowing, consumers are slowing, businesses are slowing, and residential investment is declined in this report. So don't think it's going to make any difference. We are slowing. The outlook is still going to be a recession, and the Fed is going to increase rates until inflation is under control. So not much of a change. Good report, but we'll see how it goes forward.
Great, thank you. Brandon, there's a question for you that came in. Can you discuss briefly any difference you're seeing between large and small office space?
Yeah, it's a great question, actually. So I'll start with saying, like, overall, you know, what we're seeing is, I'll talk about the overall, then I'll talk about office. We are seeing that the as a metric looking at average unique bidders, which is something we pay very close attention to, has dropped off significantly in the 10 million plus, you know, space of assets valued at the reserve price. You know, like, that buyer pool has really shrunk the largest. So if you really bifurcate it out, you know, our numbers, like, for the 10 million and below is actually still relatively strong. The larger deals, we have seen a significant drop off. You know, if you look at it as a perspective of, you know, office specifically, I've pulled up some stats while that question came in. You know, we actually are seeing, as it relates to trade rate, we are seeing actually the largest drop off is actually in the sub $1 million space. We are seeing, you know, roughly a 24% drop in that, and a lot of it has to do with, actually, we're not the seller expectation and pricing isn't as strong. Where we are seeing actually some really good movement in the office space actually is in that $5 to $10 million space. The investor appetite, the buyer appetite, is very strong in that space. You know, usually you get better quality assets. You get owners typically that are in the space and, you know, take care of those assets. And we're also seeing more the seller flex, or the seller reserve dropping is actually more aggressive in that space. So what we're seeing is that 5 to 10 space is faring very well on our platform this year.
Great. Christina, another question for you just came in. Can you comment on the future of residential multifamily properties, even if today it has been announced a slowdown on rent reduction is coming? And following on to that, what size will be trading in the market, and is build and rent going to grow because of a recession or inflation?
Yeah. Okay. Residential. Wow. Well, you know, the Fed is raising rates. The number one channel that rates are impacting the economy right now is through housing. So mortgage rates are, like, you know, they're over 7% now, or reaching or breaching 7%, which is, you know, more than double what we saw a year ago. And it's really affecting affordability, which was already being challenged because of rising home prices. Everybody was buying homes. There was very little supply, and prices have been skyrocketing there, like double-digit 20-30% price growth in homes. Similarly, multifamily has seen enormous price growth as well. Have you seen over the time, a lot of people moved out during the pandemic. They couldn't have roommates anymore. There was really strong numbers for multifamily absorption. Crazy numbers. If you say, it didn't show you that data, but it is crazy numbers if you want to go on our platform. But I mean, it's slowing now because of affordability issues. People can't afford to buy, they can't afford to rent. And so there has been a slowdown in multifamily absorption. And there's a slowing as well in sale. You've seen sales of homes just crash over the last few months. So there's going to be a slowing in the housing market just because of the Fed action, rising interest rates, and it's going to be price declines maybe in the order of single digits over the next year. Some markets are going to see more serious price declines in housing because they were the ones that grew the most quickly during the pandemic. And the build to rent, I think it's going to grow. I mean, it has been a growing sector for investors. Especially in some markets, especially in the South, in the West, and Phoenix has a lot of build to rent communities, and I think it has promise for good returns for those investors. I think that's going to be an increasing market.
Great, thank you. Martin, a question for you. What is the price range to advertise my listings online?
Yeah, absolutely. Well, it really varies. It's a pretty wide range. It can be anywhere from $50 to $100 a month on up to $5,000 to $10,000 a month. It really depends on what kind of package is built out for you. A lot of the packages include the architectural photography, and what you're really paying for is the high visibility and the high exposure to your listings. So that price increases with that exposure. So if you have a trophy asset that you're out selling, you might want to blast that exposure out into nationwide or multiple markets. Whereas if it's something smaller and local, you don't need to spend as much money. But what I would do is get with somebody who specializes in this and talk about a campaign that's specific to your need. That's pretty much it, but the range is wide. So.
Great. Brandon, another question for you. How are you leveraging technology to help brokers and owners to market and sell properties?
There's a few things there. One, like our goal is to create this, a transaction platform for brokers and sellers really to be able to, move their assets in an efficient manner. As an example for the, Ian mentioned that the number of CCIMs that have leveraged the 10X platform. They're on the technology side. What we're doing is one, helping evaluate and underwrite, the potential buyers or bidders that are going to be looking at the assets. So, we look at, like what their searching behavior has been, what type of assets are they looking at currently on CoStar, on LoopNet, and on 10X? Are they looking for retail assets, office? So they specialize in the asset that potentially they're registered to bid on. Have they had, what's their bidding history has been? Have they bid or won or bought an asset on 10X or in their portfolio that fits in this range? And then what is their proof of funds? So like the buyers have to provide proof of funds so to show they have the financial wherewithal to be able to potentially execute on that. We're also leveraging, a number of different algorithms on the marketing side of things to understand what does the potential buyer pool really look like for this type of an asset. So when we utilize and leverage the 10X transaction history to understand, hey, what is the potential market for an asset like this? But also leveraging again CoStar data to understand, hey, this is a property. It's an office property in Chicago in the $5 to $10 million range. Who's recently bought or sold similar kind assets in that market, so that then we can target those potential investors and those buyers to be able to help the brokers and sellers potentially be able to trade those assets to the most likely buyer that's out there. So those are a number of different things that we're currently leveraging, and then some things we're working on for the future to be able to give brokers and sellers more tools to be able to evaluate assets and be able to underwrite those assets and figure out what's going to be the best reserve price to be able to set that property to go on the market and potentially trade it.
Great. Stay right where you are, Brandon. I've got another one for you. You spoke about the reserves being lowered at auctions reflecting sellers' behavior. Can you comment as to how you see them behave on the resale market amid the recession? Do you see them poising for the arrivals of delinquent assets and foreclosures? I ask because so many buyers want to wait for the crash.
So to clarify the question, Matt, is what are we seeing from seller behavior now in the potential upcoming distressed environment?
Yeah, specifically about reserves being lowered at auctions reflecting sellers' behavior.
So the seller behavior we're seeing is actually it's segmented out right now. So we look at things more from, is it an institutional seller or is it a private client, like somebody that owns the asset themselves or through a family business? So the institutional sellers, we're starting to see they're actually the reserve meeting the market. They're being a lot more aggressive in what they're looking to move those assets. So again, that's usually a leading indicator for what's coming, because they're a lot quicker to be able to make those moves and make those decisions than some of the private clients are able to make. So again, we're seeing that behavior a lot. Now the private clients are actually starting to understand, hey, that are becoming more motivated, let's just say, in the changes that are shifting in the marketplace. And they understand, the positions that they're going to be in with their potential, upcoming maturities, coming next year and the year after that. And, what those, their ability or inability to be able to refinance those deals. So they're becoming more aware of the position that they're in the market that they're in right now.
Great. That's the last question that we have in the queue. So I think we're
That's
good to go.
Sounds great. Well, thank you all, panelists. That was a really fascinating discussion. I learned a lot, and I'm sure everybody else that was listening as well. For everyone out there, please, hope you enjoyed the webinar. Thank you again for attending today's webinar, and thank you for CoStar Group and our esteemed panelists for their content and sharing their insights with us. As noted in the introduction, CoStar Group is digitizing the world's real estate, empowering all people to discover properties, insights, and connections that improve their businesses and lives. For additional information on CoStar Group's industry-leading brands, including CoStar, LoopNet, 10X, please visit CoStarGroup.com. Also, as a reminder, the recording and accompanying presentation will be emailed to all registered attendees. And on that, I wish everyone a wonderful afternoon. Thank you again for joining us, and we'll see you at an upcoming webinar with CCIM Institute. Thanks.
Thank you, everyone.